But let's move on and talk about banks, which were the big movers in the last couple of days. Nitin Agarwal, Senior Group Vice President and Head of BFSI Institutional Equities at Motilal Oswal Financial Services, is joining in. Nitin, hi, good morning. Always good to see you. You know, banks have suddenly made a comeback, and some of the laggards like HDFC Bank have now come back full throttle, right? But what is leading to this up move, and where are we on the valuation argument now? Is there more upside both in terms of growth and valuations, especially for private sector banks?
Yeah, hi, good morning, Sonia, and thanks for having me. So yes, there has been definitely a good action that we have seen in private banks, and with HDFC Bank participating in that and in fact leading the rally. That has created the space overall in terms of the other larger banks also. So there was never a worry around the performance of these banks. We were seeing very strong return ratios, loan growth back to back. If you look at the last 2 years was strong for the system as such. And now going forward in FY25, we are reaching an inflection point. So last 3 years of earnings growth deceleration that was going on is now going to bottom out sometime in the second half of FY25. And that is going to be, I think, watched very closely, because beyond that, you will be looking at an acceleration in earnings. So in fact, our estimates, if I talk about like FY25, if we are looking at a 14% growth for the private banks, then this number will move towards 16 to 17% in FY26, and which is therefore generating a lot of interest in the sector now. And valuations, as you talked about, yes, the entire gap that get narrowed between PSU and private is now again beginning to take a relook, and which is where private banks are looking very attractive, both from the growth standpoint and as well as how the asset quality trends are still emerging on the ground. So which is where we are still projecting a very healthy levels of profitability to continue in the coming 2 years.
Nitin, particularly zeroing in on ICICI Bank, because yesterday you all raised the target price on ICICI Bank to 1,350, and this call came after you met with the management of ICICI Bank. So what is it that they said that made you more optimistic on ICICI Bank?
Yeah, so ICICI Bank clearly has been delivering the best-in-class performance in the prior years. And we see that this trend will likely sustain at a very healthy level, while the earning growth from the optical standpoint, yes, will moderate, given that the margins have come off from the highs. But apart from that, if you look at the way the bank is positioned in terms of overall growth, in terms of how the asset quality is trending, and in fact on the CD ratio also, wherein ICICI Bank is on the lowest amongst the larger peers, we believe that bank is well positioned to garner the liabilities and fund a healthy high teens growth. And alongside now, incrementally, bank is also looking at operating leverage as a big earnings driver. In the prior 3 years, if you look at the OPEX was growing somewhere at 21-22% average in the prior 3 years. Now, in our estimates, we are somewhere around 15% on the OPEX growth, but we believe that there is a room for bank to further control it down, and which is where we are confident that the bank will deliver a healthy double-digit growth even in FY25, when the margins are going to be like on the lower end of the curve versus the last 12 to 18 month period.
Nitin, hi, morning. Prashant here. Some of these factors, right, has been there, you would agree, for some time. But we were waiting for people to come and buy some of these stocks. So is that sort of more to do with return of foreigners? And of course, they sold the most in this sector, so there's maximum room to go in as well in that sense. Just weigh in there, or are there any other triggers as well? You know, there is this index inclusion in global bond indices. India bonds will be part of the global indices starting this Friday. I mean, it's a medium long-term trigger, but it's an important one. Hopefully reduces cost of capital overall, sort of going forward. And it's positive, financials generally. Just wanted your thoughts there. Away from the fundamentals, and is it just sort of return of foreigners more than anything else?
I think yes, Prashant, that is quite possible, because you cannot see such a big move in private banks without FI buying. So that would have definitely made a good contribution to this entire move. But if you look at last 3 years, the private banks were living under the overhang, especially the last 2 years, around credit growth, the sustainability of this level of credit cost in last 12 to 15 months, even on the margins, which have been on a one-way decline. Now, we are somewhere reaching out on the bottom on most of these things. The credit growth, as things stand today, still remains strong. The latest trend from the RBI still implies a 16% growth, which is where we are looking at a full year number to be somewhere close to 14.5, which was in question 3-4 months back. So that looks to be very sustainable. And secondly, on margins, some banks have already reported NIM expansion in the prior quarter. And until at least the rate cycle turns, we are therefore looking at more or less the margins to remain range bound with a good degree of stability to continue on margin front. And thirdly, even on the asset quality side, things are trending well on ground. So unlike some of the smaller retail banks or say SBI cards as such, wherein delinquencies have been higher, the larger banks are still placed well on the asset quality and are indicating stable trends to continue. So this thing, I think, is now being taken more and more note of, as I said, because this is a year wherein the earnings are going to bottom out and you are looking at an earnings to accelerate from FY26. So all these things together are like bringing in more interest in the sector.
Yeah, the other, just a brief comment, Nitin, if you will. So there are reports of farm loan waivers, right? There's Telangana, there's Jharkhand. With Ujjivan Small Finance Bank, which lowered their growth estimates, increased their credit cost, etc. guidance recently. Maharashtra goes to polls later in October this year. It's an important state. Will some of this need to be watched, especially with banks, especially on the PSU side, where exposure to farm loans is much higher? Just your thoughts.
Yes, this will be, of course, an important data point to keep a track on, because while we cannot really say that these waivers will result in a higher delinquencies or credit cost of the banks, because eventually the loans will get repaid by the government to them. But this does question the credit culture that will continue, and therefore the smaller lenders, especially the MFI, we have seen that even the borrowers at times stop making payments to those lenders as well, and which is where the delinquencies picks up for them. And therefore we need to keep an eye on it, and incrementally not just this, but even the ECL, which will come into being from next fiscal. The filing guidelines on that are awaited. So from both these things, I think, are very important when you look at an investment from the PSU banks as such. So pretty important to watch out for both these things.
Thanks. Thank you for joining us. And, it was nice speaking to you to understand what's driving the banks and the way forward.